You mentioned, Professor Roubini, this idea of choosing which banks survive. Who does that choosing? It seems like the Netherlands, Belgium, Luxembourg, they're doing their choosing for the banking system. How should America do that? Do the banks decide? Does the free market decide? Or should the government dictate the 10 or 20 banks that survive?
It's the government has to do it. In each one of these banking crises, the government has to figure out which institutions are distressed but solvent, given liquidity injection and given provision of capital. And then it has to decide which one of them are insolvent, and even if you're going to put money into them, they're not going to survive. You need to do this triage. Right now, there's a situation in which we don't know which one are going to survive and which not. We know that WAM was gone. We know that Wachovia is gone. We know that hundreds of smaller banks probably are bust. We know that some of the other regional banks are bust. You cannot trust anybody. What you need to do probably right now to stop a run on the banking system, because there is a beginning of a silent run on the third of deposits that are not insured. Probably you need to do a blanket deposit guarantee for all depositors for 6 months, and during those 6 months, you decide which banks are going to be closed down, and the deposits of those banks are fully guaranteed, even those that are not insured, and which one of them are going to survive. You have to do that decision in 6 months with a blanket guarantee on all deposits. Otherwise, there's going to be a beginning of a run on the banking system, because a good third of the deposits today are not insured. And at this point, you don't know, as a depositor, which one of the banks is safe, which one is rotten, which are the good apples, which are the bad apples. The government has to do it very, very fast. Otherwise, you'll have a run.
And they're doing it now by choosing, J.P. Morgan come in with WAMU and that. And off of your Chris Whalen note on your website, and the idea of FDIC is essentially conduit to the Treasury, do they choose to only have that be large banks, or do you distribute that between large, mid-size, and small banks, those that will survive?
You have to do a combination. If you have many small community banks that are going to collapse, of course it doesn't make sense to merge them with Citi or JP Morgan. You're going to merge them with other local banks or regional banks and so on. Depends on the size of the bank. If it's a Wachovia or a WAMO, given their size, of course, only one of the major financial institutions can take them over. So, of course, you're going to have to do mergers. You have to do closing down. You'll have to take over assets and put them in other banks. These things have been done over and over again in every banking crisis. It's not really rocket science. These things have to be done. The important thing is to do it fast, because at this point, the rotten apples are mixed with the good apples, and the rotten apple are going to really, at this point, through contagion, negatively affect even the good apples, because you don't know which are the rotten apples. And at this point, everybody's panicking. What's happening right now in the interbank market is a situation in which you don't know anymore which counterparty is safe. And because you don't know it, it's like walking blind on a minefield, and you don't know where the next mine is going to be. You don't know who's holding the toxic stuff. You don't know how much of it is out there. You don't know which one is going to go belly up and which one not. And until there is clarity and until this triage is done, the panic is going to continue. This is fundamental at this point, making sure you're not going to have a run on the banking system, and you're going to let those who need to survive, and those that have to go, to let them go, and do it very fast.
Jerry Paulson and Fed Chairman Bernanke were performing bank triage earlier this month. They made the decision to let Lehman Brothers go, file for bankruptcy. In hindsight, was that a mistake? Did it just make things worse?
No, it was not a mistake. Of course, the collapse of Lehman has had systemic effects, but, Lehman was insolvent, and unless the government was going to do another bear, meaning essentially buying another bunch, $80 billion of toxic assets or guarantee them, nobody was willing to buy at a positive price the assets of Lehman, and therefore the right thing to do to stop this moral hazard of a bailout after a bailout after a bailout was to let Lehman go. Lehman was insolvent. There was no reason to let it stay alive.
Well, you've been mentioning what was done in banking crises in the past, but aren't things different now in the sense that everything seems to be more intertwined? There are more and more financial products, and everything's much more international than it used to be.
Certainly, the complexity of the problem is greater in this situation, but there have been about 100 banking crises, and whenever there is a banking crisis, the key elements of what means resolution are well known. First of all, you do a triage between good banks and bad banks, and you close down the bad banks so there is no panic. So the good banks, you do blanket deposit guarantees to try to avoid a run. You make sure that then you take over some assets, but that's the exception. Most of the cases, the way the public money is injected is through preferred shares or sub-debt or common shares. Then you make sure that you take over the assets and you reduce the face value so people stay in their homes. These things have been done over and over again, and while the scale of the problem is much bigger, this is something that's quite well known. If experts of banking crisis had been consulted, this plan would have been designed in a very different way. The way it was designed was totally flawed. There was no expert opinion essentially involved into the design of this plan. That's why it was a good idea that the House rejected it.
Professor Roubini, I want to switch gears here. We had Liam Dalton in earlier on hedge funds, and he had that same tentativeness as being in the trenches of the industry, looking at redemptions. Ken Prewitt earlier talking about this August, September 30th as being an important day of fund withdrawals. You've taken an even more aggressive angle here. You say it's going to be real carnage in the hedge fund industry, right?
Absolutely. There are about 10,000 plus hedge funds. There was tons of mediocre talent in the last few years.
Oh, be nice. Come on. They're not mediocre talent. Be nice.
I mean, really, it was pathetic. Anybody who was just barely making a profit could just leave a trading firm and then raise $500 million and open a hedge fund, even if they had no clue about what they're doing. So there are thousands of funds that should not exist. And if they're going to go belly up, who cares? In some sense, the important thing in the hedge fund is make sure there is no big player that is systemically important is going to go bankrupt, because the collapse of a big player like LTCM in 1998 had systemic effects. But if hundreds or thousands of the smaller ones are going to be gone, good riddance at this point.
If the selling in the stock market we've seen here lately, if that's in part a result of hedge funds trying to raise cash to cover redemptions if they're hit with a wave of them today, is that an indication the selling may be over?
I'm not sure about that. There is now a round of redemptions, but there'll be another one at the end of the year. Certainly the hedge funds have become much more cautious now because of the restriction on short sales. Most of their strategies have gone belly up. The volatility in the market is such that nobody can make easy money, and they're all playing safe because they're all highly leveraged. They borrow like broker-dealers with an overnight repo, and now with the redemption, they might lose a lot of their money. So they have to be very, very cautious, and I think that cautiousness is going to continue. Because the hedge funds I talk to, they say it's not just the September 30. Even looking ahead, we don't know how much cash we're going to need, because suddenly our credit lines could be pulled over. Some of our brokers, that were prime brokers, might be gone. Bear is gone. Lehman is gone. The other ones are in trouble. I mean, Morgan Stanley is losing a good third of its hedge fund clients because people don't trust Morgan Stanley anymore. Really, we're in a situation of generalized panic, risk aversion, and everybody's going to stay in cash, and it's going to stay in cash for the time being because you don't know what's going to happen next.
Professor Roubini, might what we're seeing in America have an even greater impact in Europe? I mean, in the sense that we talked about everything being more interconnected, and it used to be you have European banks who never wrote a single mortgage here in the U.S., but they're holding mortgage-backed securities, and you combine that with accounting standards in Europe that are not quite as strict and transparent as the ones here in the U.S.
Absolutely. Many European banks are in trouble for a variety of reasons. We saw over the weekend at least 4 of them, one in Germany, one in the UK, one in Belgium and Netherlands, and one in Iceland, going belly up and being rescued by the governments. And that's just the beginning. For a variety of reasons, they're in trouble. First of all, there is a recession even in Europe. The latest data from the Eurozone UK suggests that all of the European economies are entering a recession. During a recession, credit losses are going to rise. Secondly, a good half of these toxic assets were securitized and sold to European investors, so they're holding a lot of this stuff in Europe, and the value of it is now being recognized down. There was forbearance for a while. Then you have essentially the credit crunch, the liquidity crunch is hurting financial institutions in Europe and corporations in Europe that depend on bank financing for their own working capital and their investment. That's another severe shock. Then you have the bursting of housing bubbles in Europe. They were huge in the case of the UK, of Spain, of Ireland, but even in places like France, Italy, Portugal, and Greece, there was fraud in the housing market. Those ones are going bust. Then add the fact that the European banks tend to be even more leveraged than U.S. banks, and the standards for risk management are as weak. And you put it all together, and you put also the fact that while in the U.S. the Fed has been cutting rates aggressively, 325 basis points, the ECB has been increasing interest rates, then the European recession is becoming even more severe, and many European banks are in trouble. At this point, this is not just a U.S. banking crisis, it's becoming a global banking and financial crisis.